Hello, my name's James Burdett. I'm a partner at Baker McKenzie in London.
Hello, I'm Bruno Bertrand. I'm a partner of Baker McKenzie in Paris. Today we are going to talk about private equity secondary transactions. James will focus on the seller side of those transactions, and I will be more focusing on the buy side of the same transactions.
Yes, the private equity secondaries market is booming at the moment. It's been in existence really ever since private equity was born more than 20 years ago. But it's grown from a small number of buy-side funds to some multi-billion-dollar deals and a multi-billion-dollar market.
We have had a lot of activity on this market since we are the trusted advisor of AXA Private Equity as buyer on the secondary market, for whom we have made about $6 billion of transaction over the last 16 or to 18 months, which allowed us to be awarded the Private Equity Team of the Year award by Legal Business last February, which was a great achievement.
Well, there are several drivers for a seller. They range from liquidity needs, so sellers who really need to free up assets for use in other markets. The so-called denominator effect, which certainly came into play after the Lehman crisis when private equity investors saw their listed equities and listed debt assets plummet in value, and therefore their private equity assets having a relatively large part of their portfolio. So some private equity investors wanted to sell down for that reason. Another reason is just simply to rebalance a portfolio so that a private equity investor can take advantage of other assets in the market. Some investors also want to lock in returns. Of course, private equity as an asset is a long-term holding, and returns aren't realised really until the end of the fund's life. To sell early is really to lock in those returns at an earlier stage. And not least, the need to comply with an ever-growing number of regulatory reforms. Those range from so-called Basel III, Solvency II, the Volcker rule. These are all essentially rules which are forcing financial institutions and banks to sell down out of non-core assets so as to free up cash for their balance sheets.
Well, there are various reasons for a buyer to be active on this market. The main one is the pricing of the assets that can be lower than when entering the market as primary investor, because what the secondary funds typically do is negotiating discounts to the net asset value of the assets when they are buying on the secondary market. So this is a great advantage of the secondary market with respect to the primary market. Another advantage is the fact that the investment period are generally much shorter than on the primary market, since the assets, the funds in which the secondary funds invest are usually more mature than when they invest on the primary basis. And this also allows the secondary funds to generate potentially higher IRR thanks to accelerated cash flows. This is what the secondary funds call in their jargon the J-curve in the secondary market.
Well, there are several things a seller should think about. First of all, there's the transaction process itself. Should it be a sale by way of auction with many bidders and therefore a good competitive tension? Or should it be a bilaterally negotiated deal between just one buyer and seller? The second thing is to look at the portfolio and see whether it should be split up or perhaps kept as a whole and sold to one buyer. Then there's the issue of synthetic deals. Synthetic deals are very helpful where there's difficulty in obtaining consent from the underlying general partner of the funds for that transfer, and therefore a synthetic solution is sometimes quite useful. Then, if there are competing bidders, the seller needs to think about whether to sell the portfolio as a whole or perhaps to split it amongst those bidders and get the best price possible. Also, when launching the transaction, the seller needs to think about the terms of the underlying fund documents, and in particular whether it's permitted to disclose sensitive financial or legal information to the buyer. The seller also needs to think about how the buyer is going to finance the deal. Buyers oftentimes go to banks for financing, but they also come to sellers to try and seek vendor financing, and the seller may be prepared to put up financing for the deal.